So I run, a small hedge fund. We run a macro strategy. I started the firm about 10 years ago. Before that, I spent many years on Wall Street working at Lehman Brothers, Morgan Stanley, Brown Brothers. So I put my time in on Wall Street, and then I went out and started my own fund.
This is American Dreams, a program where we interview thought leaders and entrepreneurs and bring their ideas to you in real world context.
Visiting here today with Heetan Doshi, and it's a pleasure having you on the show today. Your company is called Doshi Capital Management.
Yes.
Okay, so let's look back into things that transpired. Did you have clients right off the bat?
Yeah, no, so when I first launched, we launched with just my own money, for many years, a few family members, but we really just opened up to outside investors, beginning of 2020. So for a long time, it was just GP, family money, running the fund.
So when you looked at your strategy, what was the value proposition that you were bringing into this market that you didn't see already existed?
Yeah, so when I left and I launched the fund, really, living through like the tech bubble and the housing bubble, the goal was to not lose money. It was to generate returns year after year, right? Because at that point, really, is my own money, and I had to live off of it, and support my family off of it. So, a lot of people don't realize is going through a recession. Recessions take 5, to 7 years, right? At least the last two to recover your capital. So imagine if you're invested and you go through a recession, can't wait 5 years to recoup my capital, right? So really the initial goal was like, how do we avoid recessions? How do we avoid big, macro downturns? And then from there, we took the strategy and we turned into like shorter cycles of like, how do we view shorter cycles throughout the years? How do we generate consistent returns every year? And really, that became the goal, is just to have consistent positive returns year after year. So the goal for average return is about 20 to 25% on an annualized basis, and that's over time. That's over a business cycle, really. It's not year to year. That'd be almost impossible to do that, every year. But the goal is a 2 sharp ratio and, 20, 25% returns over, a full business cycle.
What should investors be thinking about and worried about in light of today's dynamic market climate?
Yeah, so I think the market is very volatile, right? We're facing things that we haven't seen in decades. Inflation is extremely, extremely high. We have the largest war since World War II in Europe going on. So there's a lot of headwinds facing the market. I think really, what investors need to focus on is what the Fed's going to do. I think interest rates have moved up significantly. We've seen the short curve come up a lot. We've seen the curve invert quickly. But I think, what investors really need to keep in mind is that the Fed is going to be, doing quantitative tightening. They're going to be reducing their balance sheet. And I think that's something that really hasn't hit the market yet, right? The market's really focused on how much the Fed is going to raise interest rates, how often they're going to raise interest rates. But I don't think we've seen that market impact of them reducing the balance sheet. And I think that's going to be, a major headwind, throughout the rest of this year. And I think, we've seen long-term interest rates rise, but I think they can rise a lot further once the Fed starts to reduce their balance sheet. So I think that's something that the investors should keep in the back of their mind.
How does the market timing strategy support portfolio diversification?
Yeah, so our goal, in terms of market timing, the instruments we use, we invest in index funds. So one, we're not picking stocks, right? We're investing in a broad index, so that's one layer of diversification. And then the second layer is, we're trying to time the market. We're trying to avoid, macro events. So when you layer those on top of each other, they provide a lot of diversification to a portfolio, and you can see that because our fund has a low correlation to almost any other asset class there is, really, whether it's equities, bonds, gold, crypto, real estate, right? So we have a low correlation to pretty much anything. And so, and from our point of view, adding us to a larger portfolio helps increase diversification.
When you look at the old 60-40 portfolio allocation? Should investors still stay with that, or should they be rethinking diversification in today's world?
Yeah, no, so they should definitely be rethinking that. I talked about this back in June of 2021, that the 60/40 portfolio was dead, right? It's worked so well because we've been in a bond bull market for 30 years, right? Rates have gone down for 30 years. So as rates go down, bond prices go up. So that's really supported that 60/40 portfolio. We are seeing an inflection in bond yields, right? As rates start to rise, bond prices go down. And so that's really going to hamper that 60/40 portfolio. And I think what a lot of people don't realize is as rates go lower, bond prices become more volatile, right? And the whole point of a 60/40 portfolio is to reduce volatility, right? It's to offset that equity volatility with a stable bond position. But in fact, as rates get lower and lower and lower, bond volatility increases. So it's almost counterintuitive that you're trying to reduce volatility, but yet you're introducing more volatility. And so, I had done a study last year that showed that over the past decade, from a risk return perspective, a 60/40 portfolio was equivalent to being 95% in equities, right? So, and you get a much higher return. So in my mind, that 60/40, at least over, the next couple of years is dead, until we see rates normalize, until we see the yield curve normalize. The Fed has held rates down artificially for a very, very long time with trillions and trillions of stimulus and bond buying and mortgage-backed security buying, right? They've really suppressed yields. So now as the Fed raises rates to fight inflation, as they reduce their balance sheet, that rise in yields is really going to hurt that 60/40 portfolio. So, from my standpoint, I mean, that idea is really dead, for the next couple of years until rates normalize.
What do investors get wrong about today's market? Is there like a
Yeah,
number
so
one problem?
yeah, I think I really saw this in 2020 during the pandemic, right? We got so many phone calls from investors, and they just didn't understand the market. And the thing that I realized that investors get wrong is they don't realize that the market is forward looking, right? It's forward looking 6 to 12 months, and people, they live in the day, the here, the now, right? They get so much news on their phone, and they see the data and the news headlines, and they wonder, well, why is the market not reacting to the news headlines? That's because the market's already past that, right? The market is a discounting mechanism. It's looking at 12 months out, where are we going to be? And we saw that in 2020. The market bottomed, and it had a really hard rally, and there were 15 million people unemployed. And I had a lot of investors calling, a lot of people calling, saying, why is the market going up so much when there are millions and millions of people unemployed and the economy's shutting down and we're in a recession? And you have to explain to everyone that, well, the market doesn't care about now. It cares about where we're going to be in 12 months. And in 12 months, there's a vaccine that could happen. The economy could be recovering, right? So I think that's the number one mistake, is a lot of investors, they don't realize that the market it's a forward-looking mechanism.
So when you look at hedge funds, or when we talk about hedge funds, typically there's a big negative connotation in the media. Can you identify why that is so?
Yeah, I think every year, hedge funds get bashed by the media. It's almost like a reoccurring theme, and I think the biggest misconception is that the media paints the picture that hedge funds don't outperform the market, right? And the market has done really well over the past 3 years, but that's not the goal of hedge funds, right? And so when the media always compares hedge funds and a broad index of hedge funds, compared to the market. And I think a few things. One, there are thousands and thousands of hedge funds, and there are thousands of different strategies, right? So it's hard to just, aggregate all those different strategies and say, okay, this is how the average hedge fund does, right? I mean, there are long short hedge funds, market neutral hedge funds, macro hedge funds, credit hedge funds, crypto hedge funds, right? I mean, just different asset classes that have different return drivers. And so to just take, an index of all of them and say, well, they're underperforming the market. Well, I mean, that you have to take that with a grain of salt. And I think, people also don't realize, the purpose of a hedge fund is to hedge, right? It's to provide diversification to a portfolio, not to beat the market year after year.
So why should investors be inside of a hedge fund right now?
Yeah, I think hedge funds. The right hedge fund provides diversification. It can provide consistent returns, right? A hedge fund is a part of a portfolio. It's not. It shouldn't be someone's entire portfolio, right? There is a place for passive investing, for just being in the market, being in the index. But there's also a portion that should be in alternative investments that can low, something that's uncorrelated to the overall market, something that can provide downside protection, right? I mean, we saw this year, just January, February, right? The markets, had a pretty severe drawdown, and so it's always good to have something to protect against those losses. And I think a lot of investors they don't realize that because they've almost been lulled into complacency that the market's done so well for so long, right? We've been in almost 12-year bull market that investors, they forget almost what volatility looks like, what a recession looks like, what being down 30% looks like. They forget that because it hasn't happened in so long. I mean, the last recession ended in 2009. I bet you most traders, that are working right now don't even remember what that recession looked like. I'm probably dating myself, but I remember what that felt like. And so I think this year especially, the hedge fund industry has seen a really big increase in activity. A lot of interest has grown because of that volatility. I think the easy money is behind us, right? The market's done well for so long that now you need to like reassess your portfolio and say, okay, where can I diversify? What other buckets can I have, right? Where else can I place, put in my portfolio to I guess, have gains going forward, considering the market has done so well for so long, and it'll likely, be choppy over the next couple of years.
So an investor new to hedge funds that want to venture into this area, what are some of the key questions that they need to be asking themselves as they do due diligence?
Yeah, I think the number one question is manager selection, right? Like I said, there are thousands of hedge funds. A lot don't do well, and a lot do well. If you look at any category of hedge funds, just long short hedge fund, for example, there are thousands of hedge funds, right? So really, it's manager selection. It's almost like picking a stock, right? I mean, if you look at the tech sector, right? You have to know which stock to pick, right? You're going to pick Apple, you're going to pick, Netflix getting cratered today, right? I mean, it's all about stock selection. Same thing for hedge funds. It's all about manager selection. So I definitely think anyone, who's interested in investing in a hedge fund, it's looking at managers. It's looking at how that strategy fits into their portfolio, right? Does it provide a benefit? Someone who has a lot of equities probably doesn't want to own a long only equity hedge fund, right? That's just exposure to the same thing. So it's about where it fits into your portfolio. It's about the track record of the manager, right? You want to see a long track record. You never want to judge someone based off of a month or a quarter or a year. So you want to see that track record, and really, you want to do your due diligence. You want to make sure that they have risk management in place, that they have staff in place, the COO, they've audited financials, right? It's all the sort of the basic due diligence that investors need to do. But I think really the two biggest thing is manager selection and fit into their portfolio.
So any advice or lessons learned as you've ventured out into your own fund that you can share with our listeners?
Yeah, I think the biggest lesson that I've learned is you need to keep your emotions in check, right? I think that applies to any investor, any investing philosophy, right? Whether you're a hedge fund or a retail investor, or no matter what you do, it's hard to keep your emotions in check, right? It's and not just when the markets are falling, even when the markets are doing great, it's hard to stick it out. It's hard not to like take profits off the table and then regret it later on. So that's the biggest lesson that I've learned is really you have to stick with your process, really, right? You have to, follow the process. You have to have your rules in place and stick to them, and not get overly involved in your emotions, especially when the markets are really volatile. It's easy to get caught up, right, in the media and the news and everything that's happening, and make a rash decision, which I have done. I've done that in the past, and I've learned my lesson from it. So, speaking from experience, I think that's really the biggest lesson I've learned is just knowing when to take a step back.
So, for the listeners who want to follow up and contact you, Heetan, how would they go about that?
Yeah, they can go to our website, www.doshicapm.com. From there they can email us, call us, fill out the contact form. It's an easy way to learn about the firm, to learn about the strategy.
Okay, I've been visiting here today with Heetan Doshi, and it's been a pleasure having you on the show today.
Thank you so much. I really enjoyed it.
Thanks for joining us here on American Dreams.